Welcome to the other side of the table. Today, we're going to pull back the curtain on how VC deals actually get put together. Trust me, it's a whole lot more than just a handshake and a big check.
So, picture this. You're a founder and an investor slides a term sheet across the table. It's got a big number on it, $4 million. I mean, wow, right? That's the moment you've been working for. But what does that number really mean? What are you getting? And maybe more importantly, what are you giving up? Because that $4 million, it's just the very beginning of the story.
Everything, and I mean everything, starts with valuation. It's probably the most negotiated, most debated part of any deal. But here's the thing you have to get. When VCs talk about your company's worth, they're not talking about one number. They're actually talking about two.
Okay, first up is the pre-money valuation. The easiest way to think about this is it's the agreed-upon value of your company right now, before the investor's cash hits your bank account. It's what you've built so far, your team, your product, any traction you have. This is a huge number to get right, because it sets the stage for how much of your company you're about to sell.
Then, once that new money is in, we get to the post-money valuation. And the math here is super simple. It's just the pre-money valuation plus the new investment amount. This new, bigger number is what the company is now worth, and it's what we use to figure out exactly how much ownership the investor just bought.
Let's make this real with our $4 million deal. So, say you both agree your company's pre-money valuation is $6 million. You add the $4 million investment and voila, you have a $10 million post-money valuation. See? Simple. But that number is the key to figuring out how much of the pie you just gave away.
And that brings us to this big number, 40%. You get that by dividing the $4 million investment by the $10 million post-money valuation. So you're partners now, right? You own 60%, they own 40%. Case closed. Well, not so fast. There's a really big catch here.
You see, that 40% doesn't even begin to tell the whole story. Why? Because investors do not get the same kind of stock that you and your co-founders have. Nope, they get a special version, kind of like stock with superpowers.
It's called convertible preferred stock. Now, the convertible part just means they can swap it for regular stock down the road. It's the preferred part that you really, really need to pay attention to. That little word gives them a whole bunch of rights and protections that your plain old common stock just doesn't have.
So here's the difference in a nutshell. As a founder, your common stock is all about the upside, high risk, high reward. But the VC's preferred stock, it's built for downside protection. And it all boils down to one critical feature called priority return. All that means is if the company sells, they get their money back first before you or anyone on your team sees a single dollar. And that priority return, that's just the start. It's one part of a whole safety net of terms that investors use to protect their investment. Let's look at some of the other big ones. So besides getting their money back first, VCs will almost always get a seat on your board of directors. That gives them a real voice in the company's direction. They'll also get veto rights on major decisions. So, you want to sell the company? Take on a big loan? You're going to need their sign-off. It's all about controlling risk.
Okay, so this is where the rubber really meets the road. All these legal terms can seem a little abstract, but believe me, they have a massive impact on who gets paid what when the company eventually sells. So let's run through a few different scenarios.
This table perfectly shows the power of preferred stock. Check this out. If you have a low exit, say you sell for $5 million, the VC uses that priority return to take their $4 million right off the top. That leaves just $1 million for the founders. Ouch. But in a great exit, say for $100 million, they convert their shares to common stock and take their full 40%. That's $40 million. It's the best of both worlds for them. It acts like debt in a bad outcome and like equity in a good one.
So you might be thinking, why is this so stacked in the investor's favor? Is it just greed? Well, no, not really. This entire structure is a direct result of the venture capital business model itself, which is all about taking huge risks for the chance at huge rewards.
The legendary investor Fred Wilson put it perfectly. Equity capital is expensive. You're not just getting a loan. You are selling a piece of your company, and you're selling it to a partner who has to justify taking a massive gamble on you and your idea.
And they aren't looking to just double their money. You gotta understand, for every 10 companies a VC invests in, a bunch of them are going to fail completely. They'll go to zero. So the one or two that actually succeed, they have to return 10 times the original investment, or even more, just to cover all those losses and deliver a return to their own investors. It's a game of home runs.
And there's a clock ticking. VCs manage funds that have a set lifespan, usually about 10 years. That means they need you to exit, to either sell the company or go public within about 5 to 7 years. This is why you feel that constant pressure to grow, grow, grow. That timeline sets the pace for absolutely everyone.
So what's the big takeaway from all this? Look, knowing how these deals are built isn't about getting ready for a fight with your investor. It's about being prepared. It's about truly understanding what motivates your new partner. Once you get why the deal is structured this way, you can have much more productive conversations and build a way stronger company together. So just remember, the valuation, that's the headline. But the terms of the deal, that's the real story. That's what defines your partnership for years to come. So the next time a term sheet hits your desk, you'll know to look beyond that first big, flashy number. You'll know to dig into the details, because that's where you find out what a real win looks like for everyone.